Well, there was a lot of warnings that were coming into yesterday. Let's put the Delta variant on the side because that was a catalyst or like a straw that broke the camel's back yesterday. But you and I have been talking about this for weeks now, where the NASDAQ was going up and making new highs along with a lot of the mega cap stocks. At the same time, the small caps, the transportation, the financials, and the retail sectors were really falling. And so we saw the warnings there. We also saw the warnings in the bond market, in the 20-plus year long Treasury bond market, because there was money going in there as sort of a safety play. So that is all kind of telling us what I think people haven't really gotten yet, even with this rally today. And of course, things can change because everything happens so fast. But that the economic slowdown after this whole back to work thing is coming, because there isn't really anywhere at this point for the economy to go. We had a statistic come out today that 1/3 of the people that were polled are saying they're going to quit their jobs. So we have a labor market issue. We have an infrastructure package which is deadlocked, of course, because of the political quagmire that we experience all the time in this country. Well, not just here, but everywhere. And then you have, on top of that, you had OPEC come out, which spooked the oil market. And now we can throw in the Delta variant, which, with all the lockdowns that are starting to recur and the cases that have gone up in the United States, was sort of like, let me out. And then, since we are very much creatures of habit, and what has been the habit we have learned over the last decade or more? Buy the dip. And that's exactly what these people have come in today. Retail investors still out there strong, lots of cash on the sideline. They came in and bought this up. In some cases, this was probably a great opportunity to buy at cheaper levels. In other cases, they could turn out to be very, very sorry in the next couple of days. We're at a point right here where I think we still need to have some evidence that the Russells and the transportation and the retail have stopped the bleed. We've had conversations from the Fed that really are supporting both sides. On one level, they are happy with the progression of things, and that's why you've been seeing this sort of just, I don't know, promise, threat of the fact that rates could rise. And then on the other hand, you have Powell talking about how he too is really concerned, particularly about the labor market. And inflation is something that nobody wants to deal with now. In fact, one of the ways to pay back a very large debt is by creating inflation. So which is going to be true? And that's exactly what the market, I think, will tell us. And that's why I like to look at the small cap stocks. If you look at the small caps, we could be happening here is a big range between 210, 230 to 235. That range could stick around, which means you're going to sell rallies and you're going to buy dips. But it doesn't necessarily mean that we're going to see this big spike in GDP growth. And that's really what we have to see here. We have to see some real growth coming other than we've come back from the pandemic. And today, finally, airlines are moving up, hotels are moving up, oil bounced back a little bit. Maybe the worst is over, but keep your eye on the bond market, the TLTs in particular, because that's really going to tell you now if we start to see some liquidation and the yields rise even a little bit, not too much to spook people, a little bit, that's optimistic. And then watch those junk bonds because they crashed yesterday and now they're right at resistance. And if they can go back up, that would put us back into a risk on environment. Right here, we're still a little bit in risk off, even with the impressive bounce. Well, then the latest threat was from China, right? That said that maybe they were not going to buy any American tech companies anymore. So there's still this, again, going back to politics, battle between China and the US that these stocks sort of get in the middle of, because people are a little bit nervous. Should I be buying Baidu? Should I be buying Pinduoduo? What should I be doing, right? Alibaba. And yes, they could be basing, and we talked about this last week too. I like to look at FXI, which is the China ETF. One of them, there's a couple, but that's the one that I like to look at. And when we talked last week, we talked about 43.50 that it had to hold. It broke down briefly under it yesterday with the market crashed, but it didn't fill a gap from when it gapped down and then gapped up. It's still holding. So I would say that if that can continue to hold around 43.50, what you're seeing from the ETF is that people are starting to feel a little bit more comfortable getting into the China market, and particularly through that ETF, and then possibly into some of the big companies there. I still am very bullish China longer term, but again, I always like to wage everything on my technical analysis, and that's why I'm looking at that 43.50. Well, cryptocurrency is being beaten up a lot. Again, let's go back to politics, through a lot of talk from government, SEC, about regulation. There are still people out there that think that if you buy cryptocurrency, you're basically supporting organized crime. Of course, the dollar wouldn't have nothing to do with that. So it's a little bit old school. There's fear about doing anything new and different amongst the older generations. And all of this has been affecting cryptocurrency. But at the same token, in fact, July 21st, you have a big debate between Cathie Wood, Elon Musk, and, oh my goodness, I'm going to blank on that other name. Oh, Dorsey, Jack Dorsey from Twitter. And so they're going to be talking about crypto. And that could be interesting because Elon Musk has been a big factor here. He's been very quiet. And it's possible through the debate that he's going to have with Cathie Wood, who we know is extremely long-term bullish, and she's buying all the way down. Maybe that would be the sea change. We still think longer term that it's not going away. Cryptocurrency is here to stay. Blockchain technology here to stay. Now let's talk about the chart for a second. If you look at the chart just of BTC USD, which is the way I can look at the chart on my platform, you have this humongous head and shoulders top, and then a neckline, which people said the neckline was 30,000. Once we broke 30,000, that's it. We're going down to 21,000. Maybe we're going to 17,000. And this is possible, absolutely, if the volatility to the sell side picks up. But at the same token, we did break that neckline a few weeks ago. We got down below 29. I think we traded to like 28.80 or 28.800, something like that. And then we immediately went right back up. So I'm going to be very curious to see what happens at that low that we had a few weeks ago. What's interesting to me is this is happening in a very orderly fashion. There's no meltdown. There's no volatility. It's just a gentle sell-off, which means anything can be the catalyst to turn it around. And the last thing I'm going to say is in terms of the hedge against inflation. Right now, people don't believe that inflation is real. Of course, I think that's foolish and very short-sighted. And so once that comes back into the realm, which I believe is going to happen in September, October, particularly as global economies get over this Delta variant and come back, then I think Bitcoin could actually run then if it hasn't run right before it.